let's talk about type of liabilities. We are talking all times about liabilities coming from PPPs. So we know that there is a direct liability and there is contingent liability. Direct liability, there is this definition is more or less capturing the features described in a number of guides and publications, and also is consistent with the definition of some laws that I have been studying. So it would be the obligation of payments that must be made in a certain manner. I mean, must be made in a certain and programmed manner. So the obligation is certain. I have to do them yes or yes, and according to a program with specific dates. Okay, and these payment obligations that are certain are in accordance to, or this programmed manner is as stipulated into the PPP contract. Okay, and contingent liability, PPP contingent liability would be payment commitments that, as opposed to the direct liabilities, in this case, they will have to be made only if an uncertain event occurs. So they are dependent on the occurrence of an event. The event can happen or not. And if happen, it can be of this size or this other size. We don't know the amount, as opposed to direct liabilities. In this case, we don't know the amount and we don't know when I will have to make the payment, or even if I will have to make the payment at all. Okay? And in brackets, some definitions talks about uncertain events that are outside of the control of the government. So they say it should not be regarded as a PPP contingent liability for evaluation purposes. Those obligations that are dependent or under the control of the government. We will talk a little bit about that. We will talk a little bit about this later. And the magnitude is uncertain, okay? And again, in brackets, some definitions say, and all this in accordance to the contract. So for some experts, some countries, some guidelines, PPP contingent liabilities should be only counted when there is a correlation with the contract, when they are explicitly described in the contract. But for some other outforce or guides, we should take into account all the liabilities related to the project, even if they are not explicitly described in the contract. Okay, there is some room for discussion there. What is clear is that some commitments, we will see that they should not be counted for the purpose of the sailing control. When we are applying a control, a specific explicit control, a specific sailing on the PPP liabilities, we should not account for any commitment, but only some of them. The majority, but only some of them. And also consider that what we are interested in is in controlling the net fiscal commitment, because there are some fiscal revenues coming from the PPPs. There are some fiscal assets related to PPPs. And for example, when I retain the property of the toll collected, so I am making payments, availability payments, but I am receiving from the users the money that is a fund that I can use to make the availability payment. So I should discount in my fiscal impact assessment my revenue that I will use to make the payments. Or when we have a pure concession that can be, I don't know, over feasible, and I will ask some money up front to the private party to get the benefit of the rights of operating that role. And I will get this upfront payment, and that is a fiscal revenue for me that I can use to free up fiscal space for PPPs. Okay, so we have firm commitments or direct commitments or liabilities, contingent commitments, minus fiscal assets, that is the net fiscal impact of a particular project. Let's go with on a little bit of detail. I'm seeing some movement in the chat. I'm very happy. We will go very soon over the questions. Okay, direct liabilities, examples, types. We can have availability payments, so payments that are linked to availability. They are not related to demand or any other kind of volume like tons of waste to be treated or cubic meters. No, it's just availability. Or these contractual explicit direct liabilities, direct payments can be linked to volume, number of cubic meters, number of tons, number of passengers. So they are variable, but they are direct liabilities, okay? Because it's a contractual commitment of a payment that I have to make, even if the ultimate figure is contingent on the volatility of the level of use of the project, okay? Or we can have capital subsidies, payments during construction, or payments, capital grants, payments for a portion of the capex, for a portion of the works. This could be made during construction, or this could be made deferred in a time horizon that goes beyond the construction period. What we are interested when we are controlling the PPP liabilities is in the payment commitments that are directly committed in the contract. Okay, so if I need to make payments to the private party and I don't have the money, and then I have to ask for a loan to a multilateral agency, for example, then I will have to repay that debt. No, I will have to make repayments to that multilateral agency. So for PPP liability control, I don't care about those payments. I just care about my commitments to make the payment as per the contract to the private party. And also, if in a contract we have a commitment for capital subsidies during construction, my recommendation is that we should not consider those payments when we are controlling the aggregated amount of PPP liabilities. Why? Because, I mean, basically it's the same than before. The question here is, listen, what are we controlling? We are controlling the danger of using PPPs as an alternative method for financing. But if I have a contract, a PPP road contract, for example, where I am asking the private party to construct the whole road, but only finance 50%, and the other 50% I'm going to pay for the works directly, this other 50% is not private financing. It's not representing commitments linked to the PPP decision. Those payments that I will have to do, what is not private finance, are subject to the same scrutiny that any conventional financing, public financing. I mean, they will be subject to maximum deficit control. They will be subject to public debt control if I need to ask for a loan to make those payments. But it's not the private party who is financing it. Okay? It's not the PPP who is creating that liability. I'm only interested in the PPP as a financing provider. So that is the private finance package, not counting with the capital grants, right? That doesn't mean that I should not take into account all the commitments coming from the project, including payments to be made during construction, or including repayments of a debt to a multilateral bank, I should consider all that from a macro fiscal point of view. I should assess all the impact when I am defining or deciding whether the project is affordable or not. But if we are talking about monitoring a specific PPP liability limit, I should not consider those. Okay? Contingent liabilities. Okay, contingent liabilities, contingent commitments will be explicit. Okay? Should be explicit. We are talking basically we are talking about the risks that are retained according to the contract. But we have also the residual risk and the implicit risk. I will describe it later on, just after describing a little bit more about explicit risks. Okay, so the most of the contingent liabilities are those risks retained explicitly in the contract, and not all those risks. Okay, not all those risks, but risks that are relevant. I mean, they have a high impact recurrence. And those that are quantifiable. So they say that if I cannot quantify properly a risk, and this is related to another feature that I'm going to describe now, I should not count for that contingent liability. A contingent commitment must be explicit according to most legislation, laws, and doctrine. However, some implicit risk as well as residual risk should be known, should be assessed, should be monitored, and should be incorporated into the calculations if they become certain or almost certain, but not from the very beginning when I am assessing for the first time the fiscal impact of the specific project. What I mean with implicit risk or residual risk, sometimes they can be the same. I mean, implicit risk, generally speaking, is the risk of making payments or suffering a cost for some kind of moral obligation. So it's not a legal or it's not a contractual commitment, but it's still I will likely decide, or I can finally decide, to make a payment, to contribute or to assume a certain cost. For example, I can transfer the traffic risk, and then the PPP project is suffering a lot, and then the PPP project is close to be in bankruptcy, the SPV, and then I could decide at a certain point of time to help the project, injecting some cash or making some payments, but I am not contractually obliged to do so. This is the case, for example, of COVID, when COVID could not be considered in certain countries under certain contract standards as a force majeure event, but still the government, like the Spanish government, which has a very exhaustive list of events that can be regarded as force majeure, and it's a closed list. So the Spanish government decided to help certain projects, to help them to face the financial implications of COVID, but we need to do that by issuing some kind of decree to override the contract. This is like a renegotiation. It's not contemplated in the contract, but I want to help. Okay, so that was an implicit risk to some extent. And residual risk is related to the idea that there is no risk that is really transferred. Okay, the same risk, traffic risk. If a project or the SPV goes to bankruptcy, and then the contract will be terminated, and I will have to pay a compensation, even if it's going to be a lower compensation than if it would be an early termination for unilateral reasons, but I will have to pay something for the works that I will take back under my control. So in the end, I'm still exposed to risks that have been transferred, because in the very extraordinary, extreme situation, I will have to terminate the contract and take back the asset and pay certain price for it. So we are still exposed. These risks should not be regarded when we are quantifying contingent liabilities in an impact assessment from the outset. But if during the contract life we are seeing how this residual risk is becoming really apparent, is very, very close to the reality, is a 90% probability that I have to rescue the project, I should incorporate them at that point, okay? Also, there is a concept of opportunistic contingent liabilities. So there can be risks that are clearly retained, for example, a change in a contract, asking the private party to do an extension of the project, for example, that they should not be counted for when assessing the control of limits of PPP liabilities, or they should not be accounted for when calculating contingencies, the value of contingencies to fund a contingency fund, because it's perverse, okay? Because those events, contract change, depends entirely on me. If I am considering the value of that risk, I am creating a fiscal space for a risk that is absolutely dependent on me. So there is I'm creating a perverse incentive for me to do a contract change tomorrow. Is there something wrong with contract changes? No, to the extent that I was not able to identify the need for such change. But there are many changes that are happening in PPPs that a proper entity, an entity that applies proper planning resources would detect to what extent can be probable that we need to expand the road in 10 years, or the airport, or whatever. We need to stop that. We should not create fiscal space for doing changes that theoretically I was not able to assess today, the need for that change, because it's not true. I should be more capable to assess changes, and otherwise this contingent liability can be regarded as opportunistic, okay? Creating a perverse incentive to do changes that could be not necessary. Contingent liabilities can be classified in terms of contractual risks, can be classified in how they impact the project, those impacting CapEx, those impacting OpEx, those impacting revenues, basically, okay? And this is important because that can influence the methodology to be used to evaluate, to quantify the contingent liabilities. And also can be classified according to the form of the guarantee. Basically, we have a contractual guarantee, a compensation event described in the contract, or an explicit financial guarantee, when, for example, Ministry of Finance or a National Development Bank is providing a guarantee instrument in favor, for example, of the lenders to cover, devaluation risks. And type of tax revenues, type of tax assets, type of fiscal assets, okay? It should be fiscal revenues or fiscal assets. We can have a payment obligation by the private party, a concession fee, in over-feasible projects that could be upfront, could be deferred, a yearly payment, or could be a variable, deferred and variable, as a percentage of revenue, for example. Or we could have the revenue directly operated by us when we are retaining the toll in a road, for example, in Paraguay, in Ruta 2 y 7. Or could be financial assets in the strict sense of the word. I mean, a loan provided by a national development bank to the company is a financial asset, okay? Or tax revenues. Tax revenues could be direct taxes to be paid by the SPV, or indirect taxes and other taxes, direct taxes to be paid by subcontractors. Okay, the upfront payment should not count it unless the amounts are going to be allocated in a dedicated fund to fund in future PPP liabilities. Because if otherwise, if we just get the money and use the money for other purposes, then there is not anymore that fiscal resource to pay PPP liability. So we should not count with that revenue unless it's going to be reserved for the sustainability of the PPP commitments. The financial assets, the public loan, for example, will only be considered to the extent that the financial conditions of the loan, of the public loan, are subsidized. Otherwise, if the price is market conditions, we should not count in any means that loan or the conditions in the PPP liabilities or the PPP revenues, because it will be neutral. Okay, if the interest rate is at market conditions, it will be reflecting the risk of the project. So both things are neutral. And typically, regarding the taxes to be paid by the SPV, when they are direct taxes, they are typically, by some countries, they are regarded as part of the revenues to be discounted from the PPP liabilities, but not the indirect taxes like value-added taxes, for example, or the taxes of other subcontractors. Why? Because first of all, VAT is neutral for financing purposes in this respect. And second, with respect to taxes to be paid by subcontractors, corporate taxes to be paid by subcontractors, we don't care about them, because there will be a part of the fiscal implications of the conventional contract, so they are not making any difference. However, the corporate taxes to be paid by the SPV are directly related to the PPP nature of the contract. Because I decided to do this contract as a PPP, I will have to assume some extra burden, which are the financial costs of the PPP, the financial costs of the financial structure of the SPV, but I will get the benefit of receiving back part of the payments that I have to make. I will receive them back by means of corporate taxes that the SPV will have to pay. So it's not bad practice to neutralize the corporate taxes coming from the SPV or subtract them from the payments that I have to recognize in the direct liability.